We have seen peak inflation talk, massive fall in interest, growth companies really staging a comeback and massive outperformance. Can you put a little bit of numbers on all of this, because it has been a very, very fast movement in market?
Yeah, it's a pretty wild ride. So if we take July alone, S&P 500 was up 9.1%. And that's actually the best July since 1939. So we're truly in historic times. But actually, if you go back to November 2020, that was a better month. So actually there's some large moves going on here. But that also has to be put into context that the start of the year, the first 6 months, was the worst start since 1970. So it's not that surprising that we see these big moves. And also recently going into the earnings season, so end of July, the mood was extremely depressed. So what we do is we track a survey in the US that asks individual investors, are you bearish, are you bullish, or are you neutral? And then we look at the difference between the number of bearish and bullish investors. And if you have a negative number, you have many more bearish investors. And actually end of June this year, it was minus 43%. So 43% more bearish investors than bullish investors. And the last time we saw that was in 2008, which means that we were extremely depressed as investors in general going into this earnings season. So it's not surprising then that some incremental positive news will move the markets in a huge way.
So we know we can explain that shares have moved on interest, but looking into this reporting season, is it only the interest, lower interest driving it back, or have we also seen some quality in the reporting season that we have just been through?
Yeah, I guess in light of that very depressed mood going into earnings season, the results were okay, and more importantly, they were a little bit better than feared. So a couple of observations. One is that companies have been able to push through cost increases to customers. And also end demand seems to be holding up from consumers so far. And then the second point is probably that the big tech giants, some of them had fallen in the first 6 months a lot, like a Netflix for instance, some of the social media names as well. They actually did also better than feared. And people kind of expected that Alphabet, Amazon, Microsoft would be the last ones to kind of falter. And that didn't happen. And why does that matter? So why are we talking S&P? Why are we talking the tech giants? The 4 big tech giants in the US is close to 20% of the S&P 500. So they matter a lot. And they've held up okay going into this. And now results were better. And especially if you look at the 3 of these 4, they're heavily involved in cloud computing. And that's still massively growing. So it's 30-40% growth in that area. So that offsets some of the more weaker areas that are directed towards the consumer. So in general, results were a little bit better. And then the tech giants held up. And if you look at estimates going into this, analysts kind of expected 6% earnings growth per share. And we ended up with around 10%. Combination with a very depressed move, and you have a 9% move in July.
You are very focused on what we can say quality growth names, the one who has the secular growth behind it, wins behind it. Can you come up with some examples from your portfolio where you actually saw that, you know, that quality in the growth really supported what was maybe a little bit surprising to the market, and market discussing should this growth fall away, but it didn't because of the quality of the company. Do you have some examples from your portfolio?
Yeah, I have to go back to the big cloud giants. I mean, it's still, if you look at Amazon for instance, their yearly run rate of their cloud business is now $100 billion US, and they're growing north of 30%. So still massive growth there, and that's truly structural growth, and it seems like it's going to continue for a next decade or so. So it's very, very impressive that that's held up, even though that the economic environment is weakening. So that would be like the standout example that we have structural growth.
And another discussion, I'm also seeing this accounting season better than feared, but actually the numbers right now are maybe falling off a cliff right now, that it was not when we look back that we could see that. What is your viewpoint on that the coming reporting season might actually be a much bigger hurdle for companies?
Yeah, so our view is always 3 to 5 years. But if you look very, very short term, so the next couple of quarters, I think there's some worrying signs there that if you listen to, for instance, Alphabet on their earnings call, they said uncertainty 9 times. So it's very uncertain what's going to happen. And geopolitics and politics plays a much bigger role these days versus just a couple of years ago. And that's really difficult to understand what's going to happen when politics plays such a huge role. So I think that's one thing. And also back to what happened this earnings season so far is that the consumer has held up and costs could be pushed through the consumer. But if the consumer is squeezed, that might fall away in the short term. So the next couple of quarters might be more difficult, and very, very short term, yet we had a huge rally from the bottom in June, so there could be some turbulence there. But if you look out even to next year, suddenly some of these names have easy comparables versus 2021. One reason growth has slowed is that 2021 was super strong, 2022 was weaker compared to 21. And if you look at 23, then that's going to be compared to 22, so slower growth in 22, which makes comparisons much more easier. So as we move out just a year, it looks suddenly better because you're comparing yourself to weaker numbers. But we're more concerned about the 3 to 5 year view, and then it's back to pricing power, quality business models, and that's where we focus most of our time.
Yeah, I know I'm challenging you a little bit because the other discussion in the market, have we pushed too far about peak inflation, lower interest that of course support some of these growth names? What are your viewpoint on the midterm? Are we too optimistic on how much we have everything under control?
Yeah, so there's no house view on inflation, and we discussed that a lot, and we're more concerned about the long-term nature of inflation versus this year or even next year. My best guess is that inflation will come down quite substantially from these 8.4, 8.5% we're at the moment, but probably not down to 2 where we were a year and a half ago, 2 years ago. But even if we have 3 to 4% inflation, our companies can still perform. So if we have steady and let's call it medium-sized inflation, that's okay if you have pricing power. But when you have inflation rising from 2% to close to 9% in a year and a half, then our companies will struggle because companies themselves will struggle to push through costs. That's going to be difficult to plan when you have price increases of that magnitude. 3 to 4, steadily growing, that's more okay.